Okay, so welcome to the recorded lecture for accounting methods for uncollectibles. Okay, methods for uncollectibles. We have two major methods. The first one is allowance method, and the other one is direct method or direct write-off method. Okay, in allowance method, we are estimating the net realizable value. In that case, we need to determine our past experiences on collection of receivables, and with the estimate, we will be able to determine the supposedly doubtful part of the receivables. So we have types of allowance methods. We have here percentage of sales method, where you have a flat rate. You just have to multiply it on the total amount of dollar sales for the period. And then accounts receivable aging, okay, where you will have an analysis of how well you are collecting certain amount or certain range of amounts, okay, and then you will determine the doubtful portion. So we will have examples of this on the following slides. Okay, so we have the important accounts to be remembered here. So the first one is allowance for uncollectible accounts, which is a contra asset account. And when you are preparing statement of financial position, you will remove or deduct this amount in this account against accounts receivables. And the second account title that we have here is bad debts expense. That is the expense we recognize for the uncollectible portion related to sales. Okay, so percentage of sales example. So here we have ABC Limited with $1 million sales for the year 20x1. It is estimated that there will be 5.5% of the total sales which will be uncollectible. Okay, there was $2,000 opening balance for the uncollectible or allowance for uncollectible accounts. So to adjust, this will be the journal entry. We have debit, bad debts expense, and then credit, allowance for uncollectible accounts. Now, when you do this, you just have to multiply that 0.5% against that $1 million sale. Okay, so take note that the amount calculated based on the sale will be the net or the expense part, not the allowance or the total allowance. So meaning the closing balance for uncollectible accounts will be $7,000. Okay, so when you do the running balance ledger account or ledger method, so you will have this way. Okay, so you have to post 5,000 on credit side. Right, so here we have if you're using T accounts, so the T accounts will show like this. Okay, so you have $2,000 beginning or opening balance, and then you will add 5,000. So the balance for this account, allowance for uncollectible accounts, will be $7,000. Now on aging of receivables, okay, so ABC Limited has an opening balance of $20,000 for its allowance for uncollectible accounts as at January 20 X1. The aging of receivables analysis is provided below. Okay, so it says here for the current balance we have $300,000, which 1% will be uncollectible. 31 to 60 days due, okay, or yeah, due 150, and then we have 5% uncollectible part. Okay, if the accounts receivable is stayed for 61 to 90 days, okay, here it says the balance will be 100,000. You have 15% uncollectible portion, and if the receivables exceeded 90 days, for that $50,000, we can only collect 30%. So you just have to multiply that balance against that percentage. So you get the total $40,500 uncollectible amount. So in journalizing it, it will be debit bad debts expense and then credit allowance for bad debts. Take note, comparing with percentage of sales, whatever we calculated on the aging of receivables analysis, that will be the balance, or the closing balance. So meaning, if we have opening balance of $20,000 and the amount that we have to record for the closing balance of allowance for uncollectible accounts will be 40,500, we have to determine how much the amount we had to add so that we will reach 40,500. So in this case, 20,500. So that is the entry or the adjustment. If you're using the T account, it will be like this. Okay, write-offs. Okay, there will be chances that when we determine whether the particular receivable may or may not be collected, if we are definite that we will not be able to collect, we have to write off that uncollectible account. So we have two methods. Again, depending on the method that you have used. If you're using direct write-off method, so which means you are not using any allowance for uncollectible accounts, you are directly writing off the bad debts or the uncollectible accounts. So you can have directly remove that from the record. So later we will show the journal entry. But for the provision method, which is the one that we're using for the allowance method, so you have to charge or remove that amount against the allowance for doubtful accounts or against allowance for uncollectible accounts. So which means you will debit allowance for doubtful accounts and then credit accounts receivable account. Okay, so example of direct write-off we have here on 31st October 20X1. ABC Limited has determined that XYZ Limited's outstanding balance of $10,000 will not be collected. So this is specific. They know that they will not be able to collect on a specific client. So to journalize the write-off, it will be debit bad debts expense and then credit accounts receivable specifically for XYZ. Okay, for provision, it will be, okay, this is an example, 31st October 20X1, ABC Limited has determined that XYZ Limited's outstanding balance of $10,000 may not be collected. So they have a balance of allowance for uncollectible accounts before the write-off, $50,000. So in journalizing it, you have to debit the allowance account and then credit accounts receivable. So when you post it in the ledger, okay, you have a big opening, or let us say, yeah, before the write-off we have $50,000, and then you have to debit that one, $10,000. That is your adjustment, and then credit, balance of $40,000. Okay, so if you put that in the T account, it will be like this. Okay, so by chance, let us say you recovered certain amount from the previously written off accounts. Okay, so if you're using direct write-off method, so you just have to reverse that previous journal entry if the books has not yet closed. Okay, so example, on 30th November 20X1, ABC Limited unexpectedly collected XYZ Limited's $10,000 previously written off. Okay, in 31st October. So adjusting entry should be debit accounts receivable and then credit bad debts expense. Okay, so if the books is not yet closed, so you can credit back that previously used account. Okay, but if it is already closed, you use the retained earnings. Okay, so as you can see on this particular entry, we just had reversed the previously recorded write-off. Now, after that, of course, you can collect the cash. We debit cash and then credit accounts receivable. For allowance method, it will be like this. So this is an example problem. 30th of November 20X1, ABC Limited unexpectedly collected XYZ's Limited $10,000 previously written off in 31st October 20X1. The balance of allowance for uncollectible accounts before the write-off was $50,000. Okay, so adjusting entry, we have to reverse the entry what we have done a while ago. Okay, so debit accounts receivable and then credit allowance for uncollectible accounts. And then after that, debit cash and then credit accounts receivable. So if you look into the T account, okay, we have 50,000 opening balance on 31st October. We had written off $10,000, and then 30th November, okay, we had recovered the $10,000 we previously have written off. Okay, so in this case, you just have returned the original balance at $50,000. Alright, so thank you for watching the recorded lecture. Hope you learned something.